Most people want the beautiful investing story. Buy a great company, hold forever, feel smart. Buffett's early game was the opposite. He looked for discarded, embarrassing businesses selling for less than what they were worth on a cold balance sheet. He called them cigarette butts. Ugly, almost finished, but with one free puff left if you pick them up cheap enough. In this video, we're breaking down how that rule actually works, how you find these situations, and the exact mindset for exiting. This is balance sheet first, not story first. Here's the first mental shift you need to make. With a cigarette butt investment, you're not buying a business the way most people mean it. You're buying a set of assets and liabilities, and you're looking for a gap between the market price and a conservative estimate of what those assets are worth. So the question isn't, do I love this company? It's, if this thing stopped being a dream tomorrow, what's here that still has value and what do I have to pay to get it? That's why this strategy shows up in places that feel uncomfortable. Neglected small companies nobody follows. Businesses with bad headlines. Companies with a broken narrative where the market has already decided they're losers. Situations with forced selling, where someone has to dump shares for reasons that have nothing to do with value. Sometimes it's just too boring or too small to matter to bigger funds, so it gets mispriced by default. That mispricing is the oxygen for the strategy. Now, what do you actually look at? At a high level, you start with what you can count. Cash is the cleanest. Receivables matter, but only if they're collectible. Inventory can be real value or a warehouse full of future write-downs, so you treat it with suspicion. Hard assets like property and equipment can matter, but you ask whether they're useful, saleable, and not already pledged away. And then you go straight to the part most people avoid: liabilities. Debt, lease obligations, pension problems, lawsuits. Any hidden claim that can jump ahead of you in the line when things get messy. The goal is to avoid paying cheap for something that's already spoken for. This is where the phrase margin of safety becomes practical. A low price isn't just a bargain. It's a risk reducer, if and only if your estimate of value is conservative. When you buy something far below what it's reasonably worth, you don't need a perfect outcome. You don't need growth. You don't need a turnaround story. You just need the gap to close even a little. Think about it like buying a $20 bill for $12. You don't need the government to redesign the money. You just need the market to stop pricing it like it's fake. But here's the part people misunderstand. Cigarette butt investing isn't about predicting a catalyst like a trader. It's about understanding what could close the gap over a reasonable range of time. That could be as simple as earnings stabilizing, a bad headline fading, a non-core asset being sold, a buyback, or a larger company deciding the assets are worth more than the market price. You're not forecasting a date. You're defining a catalyst range and then building rules around it. So the workflow looks like this. First, you screen for cheapness. Not cheap relative to last year's price. Cheap relative to a conservative view of value. Second, you verify the assets are real. You sanity check the balance sheet, you ask what could be overstated, and you assume the numbers are less friendly than they look. Third, you look for survivability. Can the company stay alive long enough for value to be recognized? A great discount doesn't help if the business runs out of oxygen first. Fourth, you define your exit rules before you buy. This matters because the whole strategy is built on not getting emotionally attached. You're not marrying the company, you're harvesting a discount. When the price normalizes toward your estimate of value, you sell. You don't sit around hoping the ugly business becomes a great one. Because once you get that free puff, the cigarette butt doesn't become cleaner. It becomes riskier. And that's the discipline most people don't have. They buy something cheap, it moves up, and instead of treating that as success, they rewrite the story and start treating it like a long-term compounder. That one mistake turns a strategy into a trap. So, if you're going to use this approach, the rule is simple. Buy with a margin of safety, verify the balance sheet, demand survivability, and pre-commit to selling when the discount is gone. Now, here's where it gets interesting. This strategy can work, but it has a cost. And those trade-offs are exactly why Buffett eventually moved on. The reason cigarette butt investing works is also the reason most people won't do it. It's ugly. The companies are embarrassing. The charts look terrible. The headlines are negative. The business model might be outdated. And that ugliness creates an edge because it keeps competition away. Most investors want to feel good about what they own. They want a story they can defend at dinner. Cigarette butts don't give you that. They give you numbers. But that same ugliness is where the strategy can break you because the market isn't always wrong. Sometimes a cheap stock is cheap because the value is leaking out faster than you can buy it. That's the classic value trap. So you need to know the failure modes cold. 1. The melting ice cube. The assets look fine on paper, but the business is shrinking, burning cash, and turning yesterday's value into tomorrow's write-downs. 2. Hidden liabilities. The balance sheet looks cheap until you notice the obligations that sit off to the side or the footnotes that quietly explain why your assets don't really belong to you. 3. Management incentives. If leadership is paid to keep the company alive, not to unlock value for owners, they can waste years doing turnaround theater. Busy plans, lots of talk, no results. 4. Accounting mirages. Receivables that don't get collected. Inventory that can't be sold at anything close to stated value. Assets that are marked optimistically because nobody wants to admit the loss. 5. Liquidity and patience. Cheap can stay cheap. And in small, neglected names, you might not be able to enter or exit cleanly without moving price against yourself. That's why time risk is part of the math. If your thesis needs years to play out, your cheap purchase might become expensive in opportunity cost. The discipline isn't blind patience. It's scheduled skepticism. You set review checkpoints. You ask, is the discount still real and is the company still surviving? If the facts degrade, you don't negotiate with them. Portfolio structure matters too. This approach is not designed for single-bet bravery. It's designed for small positions spread across multiple chances so one mistake doesn't erase your progress. You're looking for asymmetry, limited downside because of the price, plus meaningful upside if value gets recognized. But you only get that asymmetry if you refuse to bet the farm. Now, it's important to understand why Buffett evolved away from this. A cigarette butt is a one-time win. You buy cheap, you sell when it's less cheap, you move on. But a great business can compound internally for decades. If a company earns high returns on capital and can reinvest those earnings, you don't need a gap to close once. You can let time do the work. So think of this as an early-stage tool. It's a way to build capital when you don't have scale, when you can't buy entire wonderful businesses, and when mispricing is your main advantage. And for you today, the smartest move might be using the principle without going full cigarette butt. You can still demand a margin of safety. You can still treat price as a risk lever. You can still write sell rules that protect you from falling in love with a cheap idea. Even if you mostly buy quality, you want to avoid paying a price that turns quality into a bad investment. So the practical question isn't, will you buy ugly companies? It's, will you make price and exit discipline non-negotiable? Your edge isn't finding beautiful companies. It's paying a price that makes the outcome asymmetric in your favor. If you want a simple margin of safety checklist you can use before any buy, watch the next video and subscribe. And tell me this, is your bigger challenge finding value in the first place or holding your discipline once you buy?